In many ways, Dakota kind of represents our own backgrounds where we put together the best of fintech and traditional finance with what we learned and appreciate about crypto to build something that leverages and borrows from kind of both ecosystems. And so Dakota, in many ways, is a combination of that experience, both myself and a lot of our founding team. And we bring those together to build a business banking account. And that is able to leverage crypto rails, able to leverage things like transparency and be able to verify transactions that we get from our chapters and our appreciation for crypto, but also give people access to things that come well from traditional finance, access to wires, ACH payments, the like.
Hello, everyone, and welcome back to another episode of Mind with CoinFund. My name is Alex Felix. I'm a managing partner and CIO. Today's episode is a special edition, but before we get into the conversation, I'm excited to introduce my co-host, CoinFund investor George Christopher. George, how's it going?
Hi, Alex. Excited to be here today. Let's dig into the news.
Awesome. Earlier today, we announced that CoinFund led the $12.5 million Series A funding for Dakota, a business banking platform that utilizes stablecoins for speedy, low-cost transactions. Dakota helps businesses reimagine how they move money across borders, and to date, they've already helped their customers process over $1.6 billion in transfers. I'm excited because of this theme of convergence that we've been talking about for a long time, which is how do we bring stablecoins to the masses, and what are the services and functions that we can offer around those. We've added payments natively to the internet, and now we need to find out how businesses can benefit from some of the low cost and frictions there. When we think about Dakota, it's really a software business that sits on top of the existing bank infrastructure, but does a lot more than traditional fintech has been able to do for advancing the state of payments and the future of finance. This is where DeFi comes in, this is where smart contracts come in, and this is where we hope that Dakota will be able to seamlessly merge crypto rails with traditional fiat rails and give customers the best of both worlds. Another one of the reasons we're excited to back Dakota is because of the stellar team. So it's only fitting that we welcome co-founder and CEO Ryan Bozarth to Mind with CoinFund today. Ryan, thank you for coming on and congratulations. How's it going?
Thank you. Thank you for having me. Things are good over here. Appreciate it.
Excellent. Well, we'll dive in with some questions, but just to bring our audience up to speed on what you're building and a little bit of your background, maybe you could start with your professional history here.
Yeah, so my own history kind of reflects a lot of our early team. Most of us spent a chapter of our careers working within crypto companies. I led Coinbase custody for a while, worked over at Anchorage in the early days, and then prior to that, spent some time over in fintechs, places like Square, Airbnb, and the like. And so a lot of us come from one or two, or often both of those backgrounds. In many ways, Dakota kind of represents our own backgrounds where we put together the best of fintech and traditional finance with what we learned and appreciate about crypto to build something that leverages and borrows from kind of both ecosystems. And so Dakota, in many ways, is a combination of that experience, both myself and a lot of our founding team. And we bring those together to build a business banking account. And that is able to leverage crypto rails, able to leverage things like transparency and be able to verify transactions that we get from our chapters and our appreciation for crypto, but also give people access to things that come well from traditional finance, access to wires, ACH payments, the like.
Great. And what are you seeing from initial customers that are using the service? What do you think is working, and where do you anticipate that your customers will ask you to build more product?
Yeah, we've seen a lot of demand globally for simply a US dollar denominated account. And so we have access to the US banking system, US banking rails. We hold reserves in the form of treasuries and money market funds. And so for a large portion of the world, there is the ability for us to effectively export the US bank account or make the US bank account available globally based on how we've architected this product that is very appealing to businesses. The second thing that we see is that a lot of people are just kind of at the point where they are default global. They come apart with an internet age. They need things to move faster, cheaper than they do today. I'm able to use Dakota for that. And we use underlying technology, whether we're borrowing from traditional APIs or things that come directly from the blockchain, to be able to make different payment rails available, different currencies. For example, when you come into Dakota, you get access to not just Fedwire and ACH here in the US, but also things like Swift and SEPA. SEPA is a European payment rail, which gives you access to euros on day one. So a lot of these teams that are global by nature, maybe they have contractors, employees in parts of the world, vendors or partners that they work with. We are more of a global bank account than you can traditionally get, both here in the US and outside of it.
And what do you think brings us into the more efficiency realm with Dakota? I know we've seen an era of neobanks and software that's been built on top of traditional rails, especially for more consumer use cases, as well as some small medium business use cases. But what differentiates Dakota, and how do crypto rails allow for 24/7 payments in the real world?
Yeah, so if you think about the model of a kind of traditional neobank, oftentimes it's a layer of software built on top of a bank partner, generally a regional bank. And that means that you have access to the underlying product or services provided by that bank account. And those can be quite limiting, especially as you scale. And so the approach that Dakota took is that we work with a network of bank partners and also rely directly on crypto primitives themselves to be able to offer a broader set of services. And oftentimes this means kind of faster, cheaper transactions, ability to kind of earn increasingly forms of yield that customers are asking for. And so one easy example here is that we talked about something like global payments. If I'm relying on a single bank partner, all my payments are going to originate from that bank partner. And so if they need to move across the world globally, what that will mean is that they usually go through what's called a correspondent bank network. They'll have to hop through a series of banks. They'll need to settle at each one. Each one takes their cut. And so when people talk about global payments being expensive and slow, that's generally the underlying reason. When we have a network of bank partners, we can tap into directly our ability to service different payment hubs or regions. And so if I just use, for example, coming from the US and going to Europe, then going from a system where I'm relying on something like the Wire system or Fedwire, who we have in the US, to a bank account in Europe, I can actually skip the correspondent bank network. The reason I can do that is I can hold the underlying assets as treasuries that are represented by stablecoins, and I can use stablecoin rails to get all the way to that local network. And so in this case, I can send that all the way to Europe in the course of the speed of the blockchain. So let's call it seconds here. And then I can do what we call last mile conversion to convert that stablecoin into a euro or a dollar. So the recipient is just going to receive a standard dollar or euro or wherever they're located. But the idea behind the scenes, what happens kind of abstracted away from the customer, is that we can skip or kind of move around large parts of the network as we need to by relying on, in this case, stable coins and blockchain rails.
In this concept of a global operating account, is that new? Have we seen that before, or do you imagine that multinational companies will continue to have various subsidiary bank accounts all over the world, even once we make this upgrade to stablecoin rails?
Yeah, I think it's a bit of both. We've had attempts in the past of doing something like this. It really comes down to efficiency and, in many cases, treasury management when you're spinning up and having to kind of keep cash in different locations across different banks. It is possible today, but it's quite expensive, quite cumbersome, both from a legal perspective, but also from the operating expense and compliance expense associated with it. One thing that's really nice is that you can talk through and be able to really orient yourself around where your business actually looks like today, and then rely on something like Dakota or other products to be able to reflect that on the underlying assets. And so, for example, if you have an account or entity here in the US or somewhere in Europe or in South Africa, you can start to open up accounts for these folks. With a global account, you can start to move money across them in the course of seconds, not days. Of course, you're also incurring those fees. And so treasury management becomes much more looking like it's 24/7. And so you see kind of those start to kind of fade into the background as these global accounts become more efficient with this new technology. You also see the world where you can make payments much faster and be able to reallocate across these accounts much faster as well.
Awesome. Super impressive, Ryan. Maybe now is a good time to chat a little bit about some of the early successes and milestones that Dakota has achieved since launching the product. Would love to hear the updates there.
Yeah, of course. So Today, we have over 500 businesses on the platform. We've got a chance to spend a lot of time with these early customers. Most of them have dedicated support channels with us. We have a lot of back and forth. They really have kind of informed the building of the product and given us great feedback along the way. We processed now billions of transactions, or sorry, billions of dollars in transactions annualized. We have support, as we kind of mentioned, for a number of payment rails here, both in the US, but now with Swift and SEPA available as well, and SEPA giving access to euros. And then we recently also introduced corporate cards onto the product as well. And so we do all of this being able to, of course, leverage stablecoin rails directly. So if folks want to send in USDC or USDT or send it back out, you still have access to the crypto rails. You still have access to sacred addresses, access to things like DeFi, allow you to do kind of, it's called self-directed lending, but alongside some of these more kind of traditional features in traditional finance where it really shines, being able to use a card at a coffee shop that is fully backed by your stablecoin assets.
Awesome. And you mentioned the 500 customers there. That's great initial traction. And one of the things that we spoke about prior to making the investment was just the different types of businesses that you've been able to onboard. Could you talk a little bit about the types of customers that you guys have today and the various pain points that you're addressing for those?
Yeah. So we see a number of different segments that are really kind of leaning into a model like this. One is definitely crypto companies, whether you're a startup or a foundation, VCs, OTC desk, and market makers. And a lot of that is going to come from people who have the need to operate across both cash and crypto side by sides, whether they're operating in stablecoins, taking their marketplace transaction fees in stablecoins, making payments to contractors or employees of stablecoins. But that ability to both operate globally as well as kind of work across cash and crypto is very appealing for a growing number of segments, but kind of crypto represents that best. We see other industries outside of crypto. I think there's two big categories. One I'll refer to as like global businesses. We see increasingly number of companies that have global employees, global vendors or partners, and they're starting to really be able to lead into the need and see the need for access to multiple payment rails, different currencies. Stablecoins at times can be a more efficient way of moving money for those folks as well. And so you can think about those folks as e-commerce business, import-export companies, even nonprofits that are now increasingly taking on stablecoins as a form of donation, for example. And so these folks are able to kind of use a lot of like the global bank account aspect of it. But for most of them, it's a dollar in, dollar out account. It just happens to be powered by this underlying technology. And then lastly, we see folks that are coming in a space that are just looking for a more modern solution. They're looking for faster payments, looking for the actual bank account that they use to reflect how they operate. And so we see increasingly number of traditional startups, AI companies, and folks like that entering Dakota as well.
Ryan, as the stablecoin universe expands, do you see a world with many, many different stablecoins, and how might that impact your business or the marketplace at large?
Yes, I see that there's going to be both many stablecoins that have very distinct uses, as well as a couple winners that will win for interoperability, be able to move across different ecosystems. And so we see winners like USDC and USDT today. The things that matter to those stablecoins will be liquidity, brand, your ability to access to these. And then I think on the other end, you'll see an explosion, as we've already seen with coins like what Dakota does, which is an on-platform stablecoin. It serves a very particular use case where it says within this ecosystem, within a company or a network of companies or an area, there is going to be stablecoins that flourish. I think there'll be many, many of those, increasingly number or so, as more of the world becomes on chain and we see the kind of value realized from this technology. But then I think there'll be a few winners when it comes to the interoperability to kind of move across different ecosystems, both in single ecosystems all the way down to a single company. I think we'll really see over the next few years an explosion there.
And how does that play into the needs for payments companies to understand asset custody? Like, when you think about what people can store in the Dakota Business Bank, how does that differ from someone who's just allowing USDC or from a traditional custodian altogether?
Yeah, so it gives you a much broader like aperture, if you will, across like different assets that you can hold at an account like this. And so if you think traditionally what you might be able to hold, at least here in the US, it was largely US dollars. Didn't have access to other currencies. You didn't have access to kind of brokerage style services. And so kind of other currencies, brokerage, FX, all of that becomes different kind of payment providers or different kind of parts of your underlying tool belt, if you will, if you're a CFO or managing a business, especially as you grow. What's unique about this technology and what a company like Dakota can do is that, of course, we could offer kind of the underlying assets themselves, whether that's going to be treasuries or money markets, which can be oftentimes upgrade to just kind of holding cash. Is your ability to also support other currencies, both through stable coins, things like EURC, if you want to make the comparison to USDC, but also through other instruments that look more like the brokerage. And so, if you think about a lot of the real assets that we see today, not just kind of treasuries, but money market funds, corporate bonds, all of these things coming on chain, it allows for a single account to really be able to kind of be a one-stop shop or a full service provider across what your kind of financial needs might be, especially as you grow. And so for just getting started, it's a great place to be able to kind of hold your first assets and your initial balance sheet. But as you grow, you start to have more complex needs. You're able to kind of really kind of grow and support the account type, not just on the kind of what can be stored there, but also type of yield that might be interesting to you. You have a kind of spectrum, if you will, around the ability to kind of dial in what your risk profile, your risk appetite is, and be able to reflect that in your account as well, which traditionally we really haven't had much access to that outside of like more advanced brokerage style products, but not something that could traditionally serve, small to mid-market businesses. Now with kind of self-directed lending through, products like DeFi, of course, you have centralized options as well. All of these can be done from a single location.
And when you think about what is the current meta, right, which is Stablecoin Summer, what do you think some of the hard problems that still need to be solved are? We see scores of companies, lining up to start servicing stablecoins. There's obviously a lot of cross-border remittance and onboarding and offboarding ramps and various orchestrators. What do you think are some of the problems that no one's talking about that are going to make this transition to stablecoins very difficult? Maybe it's, there are still bearer assets and is it the high risk of losing them? But what are you, sort of laser focused on in terms of the hard problems we need to solve now that this technology is starting to flourish and could be adopted by mainstream?
Yeah, I think 100%. It's a really exciting period. And right now, we do see a lot of companies coming out, and it's amazing to see the kind of just like revival and then within the ecosystem. I do think that one of the areas that people tend to kind of look at as maybe something that we have kind of solved, but I think we're pretty early in the journey is things like regulation. I think we have made some amazing progress over the last year here. We still have a lot more to do. We've seen things like MiCA kind of come and take shape. We're seeing that kind of play out here in the US with the Genius Act. But a lot of these things are still early. And as anyone who's worked in reg entities and with regulators, things oftentimes take much longer than you might expect up front. And so with that regulation comes compliance. And so compliance is one of those areas that is incredibly important to products, both like Dakota, but also for anyone working in stablecoins, that oftentimes has a kind of like more nuanced approach people might realize at the forefront is that it is relatively straightforward to create a set of kind of like blanket compliance policies that might get you up and running, but really being able to operate this at scale and being able to service, for example, a global customer base like we do requires a pretty thoughtful approach to how we think about compliance, what we ask of folks, how we monitor transactions, things like that. I think a lot of companies want to take advantage of some of the properties of stablecoin, whether it's programmable, whether it's globally available, will have to figure out how they think about their own compliance programs as the regulatory environment continues to unfold. I think that's probably one of the biggest ones that we see that is maybe underappreciated in many organizations and maybe throughout the ecosystem more broadly. Another one is going to be that as we kind of go out and see these markets increasingly mature, there's still always the question of like liquidity management. As we see more of the ability for us to bring things on chain, the liquidity becomes, and sometimes more interesting problems where you say, great, I need to be able to manage liquidity now across multiple assets, multiple chains. As the ecosystem continues to flourish, this problem in many ways, it reinforces, becomes actually harder if you believe in a world where there's more stable coins available to you in the future than there is today across more networks. But it's also really interesting. The kind of infrastructure and the tools you have available changes. So now we see the ability to have tokenized treasuries that can be used as part of your reserves. And getting in and out of tokenized treasuries can be done through APIs. So all of a sudden you have access to tokenized treasuries kind of 24/7, 365 that you might not with a kind of more traditional broker model. And so you have kind of more instruments to work with, but all it's all behind the scenes to be able to help you serve and provide a better kind of reserve management and liquidity management for these stablecoins. At the end of the day, the average user shouldn't have to worry about any of this. What they really care about is transaction speed, being able to move funds across different entities, across different places, and do it at scale. But behind that, to power that, to really get there, especially as these companies kind of continue to grow, there's a fair amount of work that has to go into be able to manage reserves in an effective way and really liquidity behind them.
Awesome. Super interesting. And, as you mentioned, as more liquidity and more volume comes onto the Dakota platform, it obviously brings unique challenges, but also within payments, you see efficiency and network effects as more liquidity comes onto the platform. So maybe talk about that as more liquidity comes onto the platform, as you guys offer, the hub as a business banking solution. What sort of additional opportunities do you see, and what can you offer to your customers as the volumes and liquidity continue to compound here?
Yeah. So one of the biggest ones is that for people who have spent time in kind of fintechs or in payments, I think is most people would agree that payments is a volume game. And so the more payments that you have, the more system, the more economical it'll be. So cheaper it'll be for the end customer. The faster the money tends to move through the system. You can move more money faster through the system. You can increase your kind of both your bank partnerships and your quality of partnerships. And that becomes incredibly important for the underlying kind of payments world. And so you really see that with kind of growth, there is a true like economies of scale when it comes to just pure payments. Outside of pure payments, you see things like being able to manage and have access to more information, which allows the system to make kind of more intelligent calls when it comes to things like treasury management. And so, for example, as we companies able to understand more about individual companies' risk profile, you have access to be able to say, great, at scale, we can start to help making recommendations around treasury management, be able to look at both what is happening on our platform, but also outside of it, things like FX conversions or how yield is kind of shifting and moving throughout the world, that we can say, great, this might be a nice time for you to kind of move more money into your operating account, or this might be time to take some and move it more into your treasury to be able to earn additional yield on those assets. And so at scale, you can look at these things as really more of a data problem than anything else and say, the more I understand about the data, the more access I have to data sets, then I can make even more informed decisions, both around payments, but also in many cases more impactfully through the what's really happening on the treasury side of things or the asset storage. And as those kind of products materialize and grow, you'll see more recommendations across different asset classes, for example. So what it can do and recommend actually becomes wider. What it can actually do and recommend in terms of the impact it can have becomes much broader. And so we're really excited about both those dimensions.
Awesome. And as we mentioned, the liquidity on your network not only includes fiat, but will also include crypto. And one thing that's unique about yourself and your co-founders and team's background is your experience in custody. So maybe chat a bit about, your guys' background in custody and how that allowed you guys to build out your own custody stack and how that positions Dakota for go forward success.
Yeah, so we've spent a lot of time building qualified custodians within crypto. We got a chance to see firsthand what it really means to do that. Everything from kind of the security posture you might want to take and the options you might have available to you, but also how you might work with regulators to be able to bring those architectures to life, down to how you kind of design things and you learn what you really want to, like the use cases you want to optimize for. An easy example of this is that when we first started building a lot of these custodians, the only real strategy people had was effectively a long hold strategy for crypto. And so it was very straightforward to say, hey, we're going to rely on things like cold storage architecture to be able to have a high security product, but also not need to kind of really solve problems around movement of the funds or kind of moving funds and use cases that involve more movement. Over the course of 6-7 years now, we've definitely seen multiple strategies take place for the qualified custodians, many of which require faster money movement. And something for Dakota, for example, is being able to take that lens of understanding what's available to us and also understand what's not. And we need to invest our own time, our own energy to architect of things from a more kind of principled standpoint of how we want to optimize, for example, programmatic payments or really kind of use cases where global money movement is really important. building kind of transaction routers across different bank partners, as an example, of that to facilitate faster money movement. But really, a lot of that came from kind of working early on in the custody business to be able to really understand the security posture, the use cases, and how I might apply that to a slightly different kind of business, which cases like we don't service traditional, hedge funds and asset managers, but really applying that to businesses more globally and what they might need.
Ryan, now that you've kind of landed the funding, which is awesome, allows you to push forward and accomplish some more things with Dakota. What are you thinking about from a team growth perspective? Do you have any important roles where you're looking to attract talent? One thing I'd love for listeners of this podcast to do is to refer some great talent over to you.
100%. So we're growing the team. We think about the team as right now being kind of part of like four departments together. So we have a we'll call it our PED team, but product engineering and design. And we continue to hire engineering, back end, front end. If you are kind of senior or staff level, we have great people to work with there and are always kind of hiring across those dimensions. We are continuing to build out our compliance team. So a lot of our kind of work right now is building out folks that are going to be doing kind of day-to-day transaction monitoring and KYB review, but also kind of working with folks both here in the US, but also in Europe that will hold officer positions, things like a BSA officer here in the US. And we're continuing to kind of build out that program as well. And then we also have a go-to-market function and an operations function. On the go-to-market side, we continue to hire folks that are experts in marketing. We right now have an open rec open for folks that want to help us at a kind of go-to-market engineer or a growth engineer to help support some of that efforts as well. And on the support side and operations side, we continue to hire folks that can help us kind of better serve our customers. So if you are kind of belong to one of those four groups and you have experience in these roles, we would love to talk with you. We're actively hiring for these roles. You can find us and reach out to us on Twitter as well as on our kind of website. We have a link to our job board there as well.
That's great, Ryan. And how do you think about, kind of where we are in this stablecoin revolution today? When you set out to build this business a couple of years ago, it must have seemed like we were further away from actual adoption and proliferation of stablecoins. But maybe, just frame it in, how differentiated were your views back then? Has that become consensus now and it's about really executing and, pushing on the gas here? And maybe what keeps you up at night in terms of, how challenging it's going to be to, build a winning company within the stablecoin world?
Yeah, I definitely think a few years ago, the conversation around stablecoins wasn't quite as adopted or mature as it is today. We at the time still saw folks that saw stablecoins, or at least the value within stablecoins being for very kind of straightforward use cases, maybe remittances or kind of peer-to-peer, things like that. And so I think at that time, what we were kind of saying and doing and really investing in was a little bit more on kind of outside what the kind of average team and average kind of business was kind of like really betting on. We had a differentiated view there. We continued to work on that. I think we do now see a lot more regulatory clarity. We see a lot more adoption of stablecoins across businesses, especially outside of crypto, as fueling a lot of this. And these days, I think a lot of people are now starting to bet more on stablecoins. Where I still think that we are not kind of within like the primary lane is that a lot of the bets so far have been on things that are kind of behind the scenes or infrastructure products, where a lot of bet has happened or folks that are not kind of at the application layer, where Dakota is going to face our end customers. Those are businesses, and we still think that that is an incredibly important place to be. We think that you build brands there, you build lasting competitive advantages there, and in many ways, you're able to kind of provide a better service by kind of growing that community. And so, like, that's still an area where I think we see a lot of investments and a lot of attention happening kind of behind the scenes. I think there's definitely room for both. We partner with teams consistently that are offering infrastructure products and have great relationships with them. But that's an area where you don't see as much, I think, adoption as well. Though we do think that over the last kind of 3 months or so here, you have seen more. And going forward, we hope to see more. We really think that this is going to be a kind of new wave of kind of technology adoption and ability to kind of really use these things in ways that help these businesses. And so we'll see, I think, and hope to see more competition and more people across the stack, whether it's going to be at the infrastructure, even at the kind of protocol layer, all the way up to the application layer.
That's very cool. And anything that you're kind of thinking ahead and and projecting out 5 to 10 years in terms of how this might change, or do you feel like we're just in the early innings of pushing this snowball down the hill?
I think we're in the early innings. I think people will often see that stablecoins will have many use cases that touch the end user that people like you and I will end up using, and even folks outside of crypto. But I think what's oftentimes not fully appreciated is all of the use cases that happen behind the scenes. And so one of the big things that I got excited about that's kind of more off that, like, let's call it 5 year, maybe plus time horizon, is that using and seeing stable coins, particularly dollar-backed stable coins, which is the vast majority of them, as like the kind of next euro dollar. And so this, as an example, is when you are holding US dollars outside of US bank accounts, originally in Europe, but now across the world, you have this notion of euro dollars. I think as we kind of see this adoption of stable coins more broadly, we see them backed by things like treasuries. Really, what we're seeing is their ability to kind of export US treasuries to the rest of the world. And so I get very excited about the ability for us to kind of up level that and kind of take on those use cases. I think Dakota also fits in nicely there as being kind of an exporter of that US bank account for many of these use cases. But you look at areas like euro dollars, areas that where it isn't a necessarily consumer interest or the ability consumer impact, or at least if it is indirect, but those use cases I think are massive ones that sometimes get less attention than a lot of the kind of peer-to-peer use cases that we see today.
One question I had, Ryan, was just on your viewpoint for non-US denominated stablecoins. As you continue to see the exportation of the US dollar through US denominated stablecoins, do you think there'll be a response with the non-US denominated stablecoins? Will countries just continue to adopt US based stablecoins, or do you think there'll be a proliferation of other stablecoins that aren't denominated in USD?
So what we've seen, I think there is the kind of tip of the iceberg right now in like the demand for US based stablecoins. I think a lot of the folks that we talk to outside of the US having access to US dollars and US treasuries globally is a kind of phenomenal use case, and one that, while we talk about it a lot, is still very early on. Going back, euro dollars is a great example of that. That being said, I do think there is, over the next kind of like 5 year time horizon, a bunch of use cases around, let's call it like the G10, or like another kind of suite of currencies that there's also increasing value for. So we see like euros, British pounds. There's a lot of interest in these assets for kind of global money movement beyond dollars. Even though it might be the majority of those money movements something are dollars, you definitely see it across these called other 10 other currencies. And then from within there, I think you also see what is going to be more kind of regional or jurisdiction specific stable coins that have a lot of room to grow. I do think this is probably going to be, if I were to kind of count the waves, this is probably wave 3, but you see the ability for folks within Brazil to kind of have a more efficient system that is specific to Brazilian reals, for example. But I think we'll see it kind of sequence in that order. It's no surprise that we started with US dollars. I do think there's increasingly demand for euros, British pounds, and the like, but then also the ability for us to kind of serve local regions or hubs through more local currencies as well. But I think we'll kind of see them kind of come across as 3 distinct waves, moving from that first one down to third one.
Awesome. Great. And one last thing from a macro perspective that I wanted to touch on is just the passing of the Genius Act. Obviously exciting for the stablecoin space, exciting for the crypto space at large, and very closely related to what you guys are working on at Dakota. Obviously, it passed very recently, so its effects have probably still not been felt, but would be interested to hear how conversations with customers or potential customers have gone, especially in relation with this new passing of the Genius Act.
Yeah, I think it gives people a lot of confidence in the US and its ability to kind of lean into new technology, in this case, particularly around stablecoins, and create systems that are both going to reflect our ability to kind of innovate within the space, as well as kind of provide real investor protection. I think one of the best examples of that within the Genius Act is the 2 tier system that it relies on, which it says if you are going to issue, in this case, less than $10 billion in stablecoins, you'll be regulated at a state level, Anything above that, it'll be at the federal level. This allows companies that are earlier in their career to be able to kind of bring new products to market, provides a space to experiment while increasing regulation for folks that have seen broader adoption or product market fit. And I think that's a very healthy way to go about it. When we talk to customers, those that are close to the space and understand the regulation, what's happening, I think it's definitely felt that the ability for us to provide kind of regulated services really makes a kind of massive tailwind in terms of the confidence and trust that we can have in newer products and newer technologies.
Awesome. Super helpful. Maybe we've already covered it during our conversation as we've talking about the macro adoption of stablecoins, but are there any other hot takes that you might have on stablecoin adoption that you'd like to share during the podcast?
I think what we see with stablecoins is that there is a lot of attention given to a handful of use cases that are very important but drives the spotlight. What we don't see is that there's a number of use cases behind the scenes that I think have the potential to outweigh some of the ones that we do discuss. And so one of those is particularly B2B payments as it relates to treasury flows. As you think about businesses who have multiple entities, their ability to kind of efficiently move assets in their treasury across entities, and oftentimes that means across borders, is incredibly important to them, and their ability to kind of manage their own risk profile, earn yield on those assets, and otherwise have a compliant structure and setup. And I think over the next few years, we will see a massive kind of shift as more of the institutions start to rely not necessarily on stablecoins for the fact that they give them access to dollars and otherwise, but just because it is a kind of more efficient form of the technology that they can kind of hold on to US treasuries, money market funds, things that they're already holding on to. But by holding on to the kind of digital version of it, it'll allow for some of these properties and efficiencies to take place. And I think those are the areas where I get very excited. There's almost like built-in network effects to those things that is really appealing, but we don't see talked very often. So I think one of the bets I would make is that over the next 3 to 5 years, that'll be one of the standout use cases that is often not talked about today.
Ryan, one of the, sort of weak, underdeveloped spots around stablecoins too is privacy, and thinking about, your Venmo feed where everything is either public or you're sort of limiting access to see, who you've paid and how much you've paid them. It's great that we're operating on public rails. I think there's a lot of trust that will, allow for network effect, will allow for, the Treasury announcing that $2 to $3 trillion of stablecoins, US dollar backed, are expected to come online over the next 3 years, through 2028. But how do you see that evolving? Like, is this something that Dakota specifically will have to lean into and figure out a solution so, your Web3 company that's making salary payments to a bunch of different people can feel like those people aren't seeing how much each other make? Or do you think there's a more universal solution to, this concept of privileged privacy on top of Grails? And privilege doesn't mean, it's only the two end users, but there might need to be some oversight from regulators or, compliance or auditors, et cetera. So how do you see the world of privacy shaping up crypto payments?
Yeah, we think about privacy in a couple of dimensions. I think what we see on one hand is there's a lot of really exciting kind of new technology that is enabling privacy in the way that we're describing here. So, ZK represents that. There's new kind of L1s coming out that tackle it at the heart. And so like there's that interesting component that is like there is going to be always new technology that kind of aims to solve these use cases. And we keep an eye on that. We think a lot of them are like both production ready or being very close to production ready, and they're really exciting ways to, I think, improve the level of privacy that we see today. Another one is like it'll always kind of depend on the implementation of the technology. And so a very simple example here is that as any company or working on public blockchains, you can decide if you want to work off of segregated address architecture and omnibus structure. Both of those have pros and cons, but it really kind of depends on both how big your customer base is, but of course really it's your ability to kind of service your customers and the promise of those things bring. So in this case, an omnibus structure is used by just about every exchange out there, but also inherently provides more privacy, but also kind of tears away some of the promises of the blockchain. There's not as much transparency into where your funds are, things like that. Segregated address architecture, used by a lot of institutional products that the custodians we used to work at, provides kind of different side of the trade-off. And so you can say, great, you now have kind of transparency, you can verify transactions, but there's not necessarily the kind of same level of privacy. And so one of the kind of more interesting problems is that we'll be able to kind of leverage both of these in this case, like wallet architectures, among other things, how you implement the technology to be able to kind of find the right balance, which is like we can, for example, take in dollars to an omnibus account and then move them to structured accounts to provide the level of privacy that we're looking for. And then the last dimension of privacy that's really interesting that we spend a lot of time on is our ability to say, when you're operating across different assets, in this case, dollars and stable coins, there is inherent kind of privacy whenever you kind of leave crypto. And so being able to kind of use that in the right way as well and be able to rely on those kind of particular pieces, whether it comes from underlying bank partners or downstream vendors, to be able to enable that privacy for our customers as well.
Great. And Ryan, thank you so much for the time today. It's been awesome conversation, and congrats on the Series A funding announcement. Some exciting things coming for Dakota. For our listeners who would like to learn more about your services, more about the way that they can, integrate Dakota, what's the best place for them to track you down or find more info about the services?
Yeah, so you can visit us on our website at dakota.xyz. We're also on X, or formerly Twitter. You can find the company at Dakota_XYZ. And you can find me personally at Ryan Bozarth_.
Excellent. We're super excited to be backing and partnering with you, and wish you the best on the next steps. I'm sure we'll have some exciting updates over the quarters and years as the stablecoin wars and the mass adoption tick up. So for those who tuned in, thank you so much for listening. Let's keep the conversation going. Please leave us a review and let us know what you thought. If you'd like to follow me on Twitter, my handle is FlexThought, and George's handle is G_Christopher8. Make sure you download Mind with CoinFund wherever you get your podcasts, and we'll be back soon to dig in on some other ideas that are worth fighting for. Thanks so much.